So with the bull call spread, we're going to talk about managing the trade. So as we always say, there's two aspects to managing a trade. The first aspect is before you place it, what strikes do you pick? And then the second aspect is how do you manage it when the trade is on. So let's talk about picking the strikes. Well, the strike prices you pick will depend how bullish you are in the stock. If you're extremely bullish, well then you will choose call options which are out of the money. And if you're correct in that, you're going to win big by doing that. However, if you're wrong, you lose your entire investment. If you're moderately bullish and you'd like to play it safer, what you would do is make sure your share price is in between both strike prices. So for example, with Apple, if Apple was trading at 105, you might buy the 102 call and sell the 110 call, something like that. If you're least bullish, well then in that situation you would buy both calls which are in the money. Now, we wouldn't recommend doing that. You're better off using a bull put spread in that scenario there. But just if you want to go ahead and do it, you make sure both calls are in the money. We did this in a Google trade and we were very bullish on it, and you can see that in some of our trade alerts. The other thing to remember is that the wider the strikes you pick, the more bullish you are, but it's also the more risk you're taking. So just remember that as well. The narrower the strikes, so the difference between the two strike prices, also determines the degree of risk that you're taking. So now that we have the trade on, what do we do if it's winning or losing? Well, the first thing to note is that you can actually close these trades down at any stage. It's really easy to do by simply buying back the short call and selling the long call. Really easy thing to do. Most of the time we let it run to expiry unless we get into a situation here where our trade is winning. If our trade is winning and it's in 50% of max profit, we take that profit off the table. We just close the trade down. And we're going to show you later on in the trader workstation section how you actually close these trades down. And we would recommend you close them down at 50% of max profit. So for example, if we had a trade on a bull call spread and all we could make was $100 on it as a max profit, if we reached 50, we would close that trade down. The other thing you could do is leave the trade run to expiry. If the share price is above the short strike price, you've nothing to do, full profit is achieved, and that position will disappear from your account on the Saturday after the expiry Friday. However, if the share price is trading in between the calls, the long call and the short call, you need to close down your long call for the profit. What happens if you're losing? Well, you have two choices. You can just close the trade down for a loss and walk away. Sometimes there's nothing wrong with doing that. And then the other thing is, if you absolutely believe in your position, you think it's the right one, you think it's going to go up eventually, you can roll the trade out for more time. More often than not, we don't bother doing this. We simply close the trade down and readjust our strikes. So we tend not to roll out in the bull call spreads. We tend to roll out on credit spreads, but not on the debit spread side.